Hi everyone, hope you're all doing well, and today I'm going to talk about how to value a stock. And this is a question I've been asked quite a lot, and give some information on what I look for in a company, what key things am I trying to, which key items are saying this is a buy to me and I think I can make money on it. So it's a question I've been asked loads, and I've been kind of thinking about the right time to do it, and I just thought I need the right time where I can just kind of stand here, just mumble on about loads of stuff. And what I try and do on these videos, because it's not actually like talking about a stock, the camera's kind of just on me and the whiteboard. I try and do it with not many cuts either, so it's just fluent talking. Probably not the best time to do a big massive talking video when I've got coronavirus, but hey, I think it'll just give a lot of information out. Even if you've been in the stock market for a while, I think there might be just one or two things that you're like, oh yeah, that's a good point. And for you guys that maybe have been in the stock market for 6 months, I think this probably hopefully gives you a lot of information that will help you on the way. So yeah, hopefully I give quite a bit of information out, and like I say, I'll try and do it with just flying through, but sometimes I do tend to say the wrong words, or I mumble on about something pointless. I mean, the other day I was filming the Free Stocks to Buy December 2020 edition, and I realised after filming that I actually said September instead of December in the video, and I was like, how have I managed to do that? So I had to completely edit that bit out. You might have noticed the jump as well in the video. So sometimes I do make a bit of a mess of it, but we'll try our best to try and do it in a smooth video as we can. But yeah, getting back onto the video topic, see that I'm mumbling on already. If you can smash the like button, that'd be absolutely amazing. And if you are new, subscribe, and we'll get stuck on to how to value a stock. So just some key points to put out, and even though I'm going to make this video, it's very hard to get this topic in one video, because there's going to be points I do miss and everything like that. And every kind of stock is always different. Some of these points will work for that company and not work for that company. And I'm going to say as well, there's no pinpoint this company is at $11.35 and it's going to go to $20.11. It's one of those, there's not anything that will ever get you to that point. As a long-term investor, you're just looking to make very healthy amounts of gains over the long term. And so I'm going to give you them point of views. There's no one that will ever. There'll be people that say, oh, you can buy in at 11 and sell out at 22 exactly. Them sort of people, don't believe them. As a long-term investor, you're just making a good, healthy chunk in your money. And the main thing is, that's why you do it. You're looking to make money. And the great thing as well, when you're a long-term investor, you're looking to buy great companies at cheap values. So that's the two things I always say is, you're looking at buying, great companies at cheap values, and, be greedy when other people are fearful, and be fearful when others are greedy. And also, you're looking to make money. That's the main thing. Whenever I buy into these companies, I'm looking at this company. Why is this company going to make me money? Why is it going to go up in share value? And generally, a lot of people do run a lot of metrics, and oh, because it's got this sort of value and it's got this ratio on it. It's not always that. Companies don't follow that. The reason why people are going to buy and people aren't going to sell is because of this one metric. It's because of the long-term vision of a company and where that company is going. And it's more focused on, if a company is increasing revenue and profit by 10%, the company is going to go up in share price. It doesn't always do it straight away. Apple's example, I think it was 2018, the stock did nothing. As soon as it's got to 2019, 2020, because the company was growing revenue and profit, eventually Wall Street wakes up, bang, it goes up. So that doesn't, that's sometimes something that happens. And sometimes you look at companies and they go to crazy valuations, even though everything's saying it shouldn't do, because people just carry on paying it because there's something exciting about that company. And like I say, sometimes it's just focusing on how you're going to make money. Is it a cheap company, and is it moving things in the right way? And that's normally what will send a stock go up. And that's the main thing to focus on, and not get caught up in too many metrics, is what I always think. So just some quick rules for when I do look into a company. First of all, I'm looking for a 2 to 5 year hold. That's where I'm looking at. I think that's always the right period, because 2 years down the line, you can see where the company's going and some of the positive things take effect. And up to 5 years is where I can see most companies going. If you look at 2 to 5 years right now, where do you see things going? Well, you probably see, for example, you'd say EV space. EV space is going to be big in the next few years. There you go. So, that's a bullish industry. You look at past 5 years, where do you see EVs going? Well, you probably think they'll be there, but then you start considering, well, is there going to be a hydrogen player coming into this area or anything like that? And then you start questioning it a little bit. And that's what I mean by 5 years down the line. It gets a little bit more blurry 5 years down the line compared to, within 5 years. But you'd say like in the next 5 years, you could say like the EV space is going to be big. So that's a good area. You look at something like the gambling. So GAN. And you're looking and thinking, well, gang's going to probably be a big area in the next few years because gambling in the US is getting allowed and stuff like that. You start working out, you look at stuff like brick and mortar stores, you're like, well, footfall's going lower and lower every year. Online's growing more and more, so that's probably not an area you want to get into. So those are always things you want to look into. That's why I like 2 to 5 years, because you see what things companies are putting in place which will help them in 2 to 5 years. I think for 2 to 5 years, something putting your money in, I always aim for 100% return. Sometimes it's more than that, So I'm buying sometimes companies and I'm like, I do think it could be more than 100% return. But I think that's a great risk to reward. If I can see 100% return, I'm like, that's worth the risk to reward. Because sometimes it won't happen. Sometimes it does go wrong. But the reward is if I get it right, 100% return. And sometimes it's not always 100% return. Sometimes it can be 60, 80. But at some point when I'm looking at it, I do think there's 100% upside. And the next thing is looking for a great stock, a great company, and it's at a cheap price. And that's the biggest upside. If you're buying a great company that has so much growth valued in, that company is only going to do, 10%, 20% more upside in the share price. Whereas you get a great company at undervalued prices, that has more potential to go up. And that's something you really want to be looking for. One rule that I do tend to have is that I like to buy a company that has at least 5% revenue or profit growth. That normally, like I say, when people buy companies, what's the reason share price is going to go up? It's because they're doing well. And they're doing well through profit growth and revenue growth. And that's what I like to look at. I think a company needs to have 5% revenue or profit growth, because that's why people are going to be bullish on the company, and that's why they're going to be buying the company. So that's one thing I do like to see. I'll be honest, sometimes 10% is a bit more where I do like, but 5% is about right. And the next thing is balance sheet. Now for me, balance sheets are key for a company. I only buy companies that have good balance sheets, really. Sometimes I can be a little bit, if it's like a cruise line, for example, obviously, buying big ships isn't going to be cheap. You're not going to have any debt on the balance sheet. There's going to be debt on there. So that's another thing. And the big thing, people get caught up in debt to equity and everything like that, which is something I do like to look for is, debt to equity. And one thing, I just missed that out on the share price. Something like this is an overreaction. So something like my favorite thing to do is if a company misses earnings and people are like, oh my God, but really it's a short-term thing. On the stock price, that's normally a great thing to buy. I'd never buy stocks at 52-week highs, really. I like getting them on discounts. But that's another thing on the getting a stock at cheap prices. That's something I do look for. But just on the balance sheet, a debt to equity ratio below 50% is normally good. But one thing I do like is cash, and having a lot of cash there. If a company gets fined, you can't say, oh, well, we've got 5 billion in assets, so we'll pay you with assets. Don't work like that. A company's got to have cash. So for me, I like having a company that has a lot of cash on that balance sheet. Depending on the market cap size, obviously you expect more cash if it's a big company. So if you have a company, for example, that has a 10 billion market cap, I don't want to see a company with a 10 billion market cap have 10 million in cash. It should have something a little bit more than that, probably at least in the 100 million. So, kind of judge how much cash it is by the size of the company. A strong debt to equity is good, but definitely a lot of cash. And like I say, debt wise, I don't like seeing a company with loads of debt. If a company has double the debt to cash, that's normally another red flag for me. But that's something on there. So we're going to start off proof probably what I think is the easiest one, which is dividends. And as well as dividends, we've got value, which I probably say is the in the middle, and I think the hardest one to value a growth stock. Yeah, that's the tricky one. So dividends, value, and growth. So dividends for me is, I can do this one probably within the next few minutes. So dividends for me, there's only a few things. So factoring this in, I do like to see the company has growth because you get share price gain as well, or it probably won't go down that much in share price, because the worst thing is you buy dividend stocks and the share price, goes down, because that pretty much wipes your dividends out. So I do like to see 5% growth and a good balance sheet as well as this. But it doesn't matter so much about getting a great stock because you're focused on dividends rather than share price. I do like to do a few of these things, but the main thing about dividends is that I'm probably going to be looking for a company that's going to carry on doing well in the next 2 to 5 years in a strong industry. But as well as that, it also has, like I said, a little bit of growth, balance sheet, but when they're paying the dividend, a decent dividend yield. And also I'm going to check that dividend yield is pretty low, probably below 60% payout ratio. And then that means they can afford to pay it out. Now for me, the websites I use to check these are Yahoo Finance and Simply Wall Street. They're 2 really good websites to use for dividends. But like I say, for dividends, you're not too much getting involved in the company. You're more focused on is the dividend able to still be paid out. So yeah, I would say that this isn't so much. And like I say, I tend to not just go for dividend stocks. I normally get value stocks with dividends. So for example, like Altria and Airtel Africa, Legal & General, I still would class these in this category rather than this. I don't do too much of just dividends. I'd at least buy a company with a good dividend that's also a value stock with some share price. So them sort of companies, I'm going to, like my Legal & General, even though it's a good dividend stock, I would still do a lot of these here and use a lot of value ones. So I'll go through that one next. So next up is how to value a value stock. So I'm going to try to give as many details as I can in the next few minutes about how I value it. Like I say, it's very hard to cover it all really in this one video, but I'll try to do as many as I can. So I guess the chart is probably one thing. So when I look at the chart, I'm looking at has the stock been on an uptrend and then we've had a pullback? Is that pullback because of some overreaction news? And then I can buy a stock at cheap prices. So I'm looking at the chart. The chart might be saying that it's had a bit of a sell-off. Is this sell-off getting buying in? Look at historical values. Is this company always been trading at a lot of a bigger, richer valuation? I find a lot more out about the chart. Realistically, I want to see how this compares to the historic value of the company. And like I say, I want to see if there's a sell-off in there, if it's cheap compared to where it's normally been. Am I still buying at 52-week highs? That's one thing that I really like to use. And then the next up is the market cap. So market cap, I like to see how much the company is valued at. Look at the revenue, how much am I paying up for a company, everything like that. Compare the market cap to very similar companies. And like I say, you always want to be comparing as well to other companies in this sort of sector, not in general, because then you get a good idea how they're valued. But yeah, the market cap is something that I'll be checking on because like I say, you look at some companies now and, you look at some of these EV SPAC stocks and they're like, I'm paying, 16 billion for a company with zero revenue or 100 million revenue for a 16 billion company. It's crazy. You won't pay that for that sort of valuation. So the market cap is something that I'd look into. The next up is ratios. So I'm going to save myself a lot of time here because I'm not going to go through every ratios, but these are some ratios that I would use to value this stock and see how cheap it is. And also I could use some of these ratios on previous values. So for example, one that I do really like to use is a P ratio, for example. And use this P ratio. So the last value stock I bought was Turtle Beach, which the P was one of the big standout things. I could use the P ratio to see historically, is this a cheap P to what it normally is? Sometimes it isn't, sometimes it is. I can use the P ratio compared to the industry. So I'll look at Turtle Beach and I'm like, it's a company doing really well revenue, but it's massively undervalued compared to the industry. So it's undervalued from that point of view. But yeah, there's a lot of ratios that I can use to work it out. But yeah, there's different ones that you can use out there. I know people like to use like price to book ratio, for example. Like I say, there's definitely a lot of ratios that you can use. I tend to look at a few ratios and that gives me a good idea, but I don't kind of get caught up on it. It just gives me an exact idea of the valuation. So after looking at a valuation, like I said, what I'm going to do is I'm going to compare this to, I'm going to use my last actual value stock that I bought, which was Turtle Beach. So for example, for Turtle Beach, before I do that, I'm going to say that also, obviously I'm looking at the growth, because I want to see decent growth in the company. That's why the share price is going to go up. And sometimes you can use analyst forecasts. That will help you. But I also like getting my own forecast as well. So for something like growth, I want to go through the investor relations, see what they think, the positive things that they're putting in, the reasons why that growth's going to go up, why people are going to get excited by this company, why people are going to buy it. So I need to, again, plan on why the growth's going to go up in this company as well. And obviously the balance sheet as well. So what I'll do now is I'll actually put the last value company that I bought, which was Turtle Beach, and walk you through exactly how I got this valuation and why I believe that it has 100% upside. So let's say I bought Turtle Beach. Now the chart pretty much said to me that it is on a good run. However, it's not historically the most it's ever been. So it's probably got a little bit of value there, but it has been on a good run. So something to be a bit cautious of there. Market cap, very cheap. It was a very cheap valuation compared to some of its peers. So you look at the market cap, it was quite cheap, especially for the revenue growth it was putting in. Ratios. So I run through ratios and look at P ratios on this one. The P ratio of Turtle Beach was like 8 or something. I look at the industry, it's a lot cheaper than the industry. I also look at competitors, it was even a lot cheaper than a lot of its competitors. And when I think about growth companies tend to grow to be a P ratio of at least 16 or above, which this company will be, which we'll get onto a second. And I'm like, well, that's cheap. So the ratios for a growth company here was really cheap. And then I looked at the game plan of Turtle Beach and I was like, right, why is it going to go up in share price? Why are people going to buy this after me? Why is it going to go up into value? And I look at the growth plan, I'm like, well, they bought another company which will help it into another industry now. It's got, there was a new gaming cycle going on, and because there's a new gaming cycle going on, that's going to set an explosion out of people wanting to upcycle their gear. So this company will do very well from the sales over the next 2 years of a new console cycle. So very quickly, value company wise, that's what I was looking at. It's a very cheap valuation historically wise. I look at the market cap, very cheap. Ratios are all coming up cheap. And I look at the growth plan. Why are people going to get excited? Why is the company going to go up? Why is the the revenue going to go up? Why is the profit going to go up? Growing industry, got its game plan in place. Products are going to do well. And that's how I managed to think, well, this company really, when you look at the competitors, historic value and the ratios, this company should be somewhere around about a 16p ratio, which means it has 100% upside. And then also you factor in the growth that it's going to have over the next 2 years, it's going to pull out. This potentially has about, if we say 16p to be fair valued compared to its competitors. And then we think about now, when we put the revenue growth in, that it's going to grow about 10% year over year. That means, and the P ratio dropping and the profit growing, it means that it's probably got about 150% upside really. So yeah, that's how roughly I came to the valuation of Turtle Beach having 100% upside, the growth plan it has in place, the valuation compared to its competitors and its current valuation and historic valuation. So that's how I pretty much got straight to the value of a value stock that I bought recently, Turtle Beach. And we'll take a look at growth companies, which I have to say is a little bit more trickier because you're potentially buying for the future and you don't exactly know where that future is going to be. But we'll talk about growth companies, which is the last one. So we can take a lot of things really from the kind of growth, value side of it and put it into growth side of it. So same again, we can use this. We can use a chart. Historically, how much is it sold off? How cheap is it? And we can use a market cap. Same again, how much revenue is it doing to how much we're paying up for. We can use ratios, but we're probably not going to use the same ones as a value stock like a price to book and a P ratio. The best ratios to use for this one is like forward P ratios. I like using price to sales ratios on this one. For me, price sales ratio, probably something under, I'd like to say under a 5 would be really good. Realistically, a single digit would be good. Sometimes they do go up a little bit more than that. And sometimes you need to be a bit, you are paying up for a growth company, you're paying up for the future. It's just working out how much future is you basically paying for, and you don't want to be paying too much for a big future, for example. And same again, definitely the big thing is you're looking at the growth plan at these sort of companies. So once again, I'll use my last growth stock purchase and how I value that growth stock, using these sort of things. So the last growth stock I bought was probably Beyond Meats. I could use other companies, to be fair. I'll try use a few different companies here, but I'll try walk you through it because, like I said, it's different for every sort of company. The companies that are going to be they're going to be the massive companies you're going to pay more and more growth up for. Like your Teslas, for example, something that has the potential to be a future single billion company you won't pay as much up for, but when you're paying for a company that's going to be 30 billion, 40 billion, 100 billion, there's going to be bigger, you're going to be paying up for that one a little bit more. So once again, chart, you're looking at what's going on, how cheap is it? You're buying at 52-week highs, you got to be careful. It's had a pullback. It might be a good time to go buy it. So you're looking at what's going on here. So you want to see what's going on really with it. With market cap, same again. You want to look at what revenue it is. Like I say, if you're buying a market cap of a company with a 16 billion market cap on a growth company and it's doing 100 million, you're overpaying for it, aren't you? 16 billion for a company that makes 100 million is a lot. I mean, even if it said it were going to do 16 billion next year, you're like, what was if it doesn't have that revenue? So yeah, market cap, you got to look at what it is, how much it's going to be. So for Beyond Meats right now, I think it's like an 8 billion market cap. But realistically, I think that when I look at the revenue side of it, Beyond Meats is probably going to be growing 100 times revenue over the next few years. And when you think about, I think it puts in 200 million revenue and it's 8 billion. And then you look at some of the corporate deals and the revenue that's going to ramp up and it's 8 billion. I mean, realistically, this company could be 30 billion in the next few years. So, when you look at the amount of growth that Beyond Meat's had, for example, it's crazy. But I'll just compare it to something else. So I bought like a tattoo chef the other day, which is like a 1 billion market cap, which is making like 200 million as well, I think, in the revenue side of it, or something around there. So then you look at Tattoo Chef, which is a 1 billion market cap, and the company is making like 200 million revenue. So it's only 5 times what it's putting in revenue, which seems pretty cheap, really. So that's, a growth stock that's really cheap. Whereas Beyond Meats has the potential to be a company that's going to be worldwide, so you're paying a bit more up for that growth. But when you say, you're looking at a company that's going to be billions in revenue, potential market cap of 30 billion, it doesn't look too bad. Same again, you're looking at something like a price sales ratio. I like forward P's if you can. Sometimes you won't get that if they're not profitable. Sometimes you can work out how much if they were to, so if you do, I'm trying to remember it off the top of my head. So if you do the current market cap divided by the profit, you'll get what P that would be. That's sometimes that you can do to help you get some sort of P valuations. But yeah, ratios are like, price sales ratio and forward P ratios and everything like that. And then the growth side of it, same again, you need a plan. And, you look at Beyond Meats and you're like, realistically, if it starts signing massive deals with Starbucks, Pizza Hut and everyone like that, you get a bull case why the revenue is going to go up 100%. And, if the company keeps going up 100% year over year, it's not going to stay at this sort of valuation. So you got to get in, why are people going to buy this company? Why is the share price going to go up? So you're going to look at something like that and look at some deals it has in place, what plans the company has in place. And you look at what's going on really with the company. So, yeah, you're kind of judging like what the plan of the company is in place, and that will help where the share price goes in the future. And same with the profit side of it, you want to see, how much that profit's going to grow, how much revenue is going to grow. Sometimes you can use analyst forecasts. Sometimes I have it in the presentation as well, and figures they're expecting to do, which does help. Other times you're kind of relying on your own to kind of go, if they have that deal in place, that will help it so much. So yeah, overall, that's kind of like, what I would say. And all the time I'm focusing on where the company's going to be in 2 to 5 years. Can the share price go up 100%? And like say, use that with, historic value ratios. You're looking to try and get a company that's, I normally like them when they're sold off instead of buying at 52-week highs. Normally that's a really good time to be buying them. Looking at, growth, I like companies with growth because, growth is normally why people buy them. And balance sheets, and like I say, key points for dividends for me is, payout ratios, and if they can carry on paying it with the company doing well. Value stocks, like I say, you're looking at, cheap prices, cheap valuations compared to competitors as well. Maybe if it's sold off, for example, the growth plan they have in place, and more with growth stocks, you're looking at how are they going to scale up and how much you're paying up for them. At the end of the day, it's very hard to value growth stocks exactly right. Because there's not many, metrics you can use. You're just kind of working out how big of a valuation is this for the revenue it's putting up and the revenue that it's going to increase over the next few years and the growth plan it has to get there. Because the key thing that I want to really say is that you're looking at buying cheap stocks for 2 to 5 years and why is that share price going to go up? You know, think of the reasons why the share price is going to go up in the 2 to 5 years. And if you have the bull case reasons, normally people buy the company because they get excited because of them reasons and the revenue going up. So hopefully that's everything, and you found at least one tip useful in there. Let me know if there's any other topics you want me to touch on, but it's a video that I've been wanting to do for a while, so hope you did find at least some positive news in there to help you with your investing anyway, and hopefully I didn't mumble on too much and made it pretty clear as well. So hope you enjoyed it. Smash the like button, subscribe if you're new, and I'll see you in the next one.